Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? I hope you're having a good day out there. From time to time, I take for granted the things that people may know about that I think are basic, but everybody's got to learn at different points, and that's what I love about making these videos is, we ideally hope you want to join us and, you use us here, but I get to look at the comments and stuff and see like, wow, I didn't know that was something people needed to learn or just had questions on. So I love it. And this one actually today is based on that. We're talking about short-term versus long-term capital gains, but in particular, the accounting method. What? Don't let it like eyes gloss over and you get all frustrated here. Let me explain really quick, because I've become obsessed with every single dollar counting for everything. And so we're focusing on wealth tips now and all this great stuff with clients, but every dollar makes a difference. If we take a look at the short-term versus long-term capital gains rates, you can very quickly see, like here, this is for married filing jointly, right? Here's your income levels in the various short-term capital gains rates, which are just your ordinary income tax rates, the different brackets you fall in. And now over here is long-term capital gains rates. The difference with short-term and long-term capital gains rates is that you don't actually pay them in, how do you do it? In a tiered sequence, right? You fall into a bracket, you pay 15%. You fall into a bracket, you pay nothing. So you can just quickly, without going into this part of the discussion, you can quickly see that if your income is of a certain amount, you would be entitled to pay a certain short-term capital gains rate. It would be ordinary income in this case, but you'd have no long-term capital gains. What I want you to notice is that over here, these numbers are always, or almost always, smaller than these numbers over here for the most part, right? If you're single, it's the same concept, but these numbers are almost always smaller than these numbers. And all we're really saying is, if you own a stock for more than a year, you pay in the smaller number category. If you own a stock for less than a year, it just counts as income, and you would end up paying in your ordinary income, whatever that happens to be. So it's very important that if you're a longer term investor, whether you're single, married, filing jointly, whatever it happens to be, very important that if we can get that tax advantage, we want it. Now, if you're a trader and you're buying and selling and stuff, well, you have other strategies for tax savings as well. But we're talking about the people that buy something and maybe they like it and it's going well, so they just hold it. A couple months go by and they're like, hey, this is pretty cool, paying a dividend, all is good. 9 months go by, 10 months go by, and you're saying, I don't know, I'm thinking about selling it. Well, if the difference between selling it 9 months from now is 22% or 15%, a couple months after that 9 months, so after 1 year's time period, if the difference is between 15 and 22%, well, wouldn't you want to kind of wait and pay the 15%? And again, I'm talking about brokerage accounts here. I'm not talking about IRAs, but we want to make the most use of that. Now, your brokerage account generally will use what's known as FIFO for the accounting method. It stands for first in, first out, meaning the first stock that you bought 9, 10, 11, 12 months ago, whatever it happens to be, when you go to press the sell button, that will be the shares that get sold. And so the question that comes out after all that long talk there is, what if I buy multiple times, right? So let's say that, for example, I put together something of Costco just to show you. Let's say that you liked it and you started buying it, and you bought 100 shares on June 8th last year, 100 shares on July 2nd, 100 shares on September 4th, and you're happy. You own the stock, it's doing well, you got your one-time dividend there, that big one they just paid out, and so you go, well, all right, I'm thinking about scaling out. I've got a total of 300 shares here, it's doing well, maybe if it goes to some level, I'll sell it. Well, your platform says when you sell, or if you sell 100 shares, you'd be selling June 8th's shares. If you sold all 300 shares, different story, but you're saying, I'm selling all of June 8th's shares there. If tomorrow you sold another 100 shares, you'd be selling July 2nd. Well, as of the time of this video here, it is neither June 8th nor July 2nd. So you would be paying the short-term capital gains rate, right? And it's how it would be reported on your 1099. So if you were to just wait a couple days, 1 day at this point, you would have over 1 year's time of owning this stock, which means you would pay the long-term capital gains rate wherever your income falls in. That's where you would be. And so it might benefit you if you're thinking about selling 100 shares to just wait a couple days, right? Get that better tax treatment. And this is the real focus for long-term investors, right? Now, if you want to sell the bulk of your position July 2nd, you would just want to wait till July 2nd if that's possible, or you're comfortable waiting that long. And then you'd have to wait till September 5th to sell out your last of your shares. So first in is the first out. Next in is the next out. Final amount is the final amount out. Now there's another accounting method. It's called LIFO. Last in, first out. And all that means is that when you press the sell button for 100 shares here, it wouldn't go to the first ones, it would go to this one. And so you would be naturally selling something that you have owned less than 1 year, and therefore you would pay short-term income, ordinary income tax, right? Then it would go backwards from there. The last one before that, the last one before that. Now this is less ideal, obviously, for someone who is wanting to have the best tax gains rate, long-term capital gains or short-term, but it's more built for someone who is trading around a position. So, for example, you would use LIFO if you bought 300 shares and you said, I am never going to sell those shares at Costco, right? And then, but in the meantime, you like to day trade a little bit. You like to buy and sell for day out, just to hold for a couple of days, try to make a little profit, and that's what you do. Okay, well, these essentially get put off to the side. LIFO would say you buy and sell and buy and sell and buy and sell and buy and sell, all that great stuff, but these still are ticking away, long-term capital gains rates. That's what that really means there, or when most people would use them there. All right, so there's the example. Now, almost every brokerage firm that I know of defaults to FIFO. You have the ability to ask to change it. For example, you like Robinhood. So Robinhood's default is FIFO. 99.9% sure it is. I highly even doubt they let you change it. So FIFO is the default. You don't have to do anything. Some of the more active brokerage firms, the larger ones out there that are more or less retail oriented, will ask you when you open up your account. If they do not, then FIFO is usually the default, but you can request to change it to LIFO if for some reason you want to. So that's it. That's all I have for you. It was about a longer way of going about it than I normally do, but I appreciate you watching. I thank you for leaving comments and everything, because we actually do kind of see and understand what you guys want to learn. Sometimes we go really geeky and have crazy topics, and sometimes we talk about things like this. Hope it helped. Enjoy the rest of your day.